Okay, so to begin with, we have the dynamic aggregate supply and demand model with short run aggregate supply, long run aggregate supply, and aggregate demand. And if we look at what the Reserve Bank of India was trying to achieve by decreasing the interest rate, that is what we're going to call expansionary monetary policy. And this is achieved by increasing the money supply in the country. So if we look at this graphically, the increase in the money supply is going to shift the short run aggregate supply curve to the right, creating this new intersection with aggregate demand. And this new intersection, if we look all the way over here, is going to indicate a decrease in the price level. We'll call that P1, and an increase in real GDP or output, and we can call that Y1. So this increase in the money supply is going to decrease prices and interest rates, making investment opportunities more attractive. It is also going to increase, you're going to see this shift along the aggregate demand curve from there to there, which means with lower prices, consumption and spending is now more attractive compared to saving. So this is going to cause that shift in real GDP as people are spending more and investing more rather than saving their money. So if we look at the case of India, this is where their real GDP was at 2015 without the change in policy. And now with this expansionary monetary policy, you're going to see this shift to this new spot there and this new level of real GDP. Now, the hope is in the long run, with enough sustained output, the long run aggregate supply curve would also shift to the right and creating this spot as India's new long run equilibrium point. But again, that is uncertain at this point because there's not enough um, data in this scenario to see what the long term effects would be. But that would be the hope.